Today I'm going to take a little bit of a deeper dive into home equity lines of credit and their uses and touch on a little bit about home equity loans. And that's a good place to start. Let's just talk a little bit about the definitions of those things. A home equity line of credit is a revolving line of credit that is secured by your home. Usually it's in second lien position, meaning that it's recorded behind your primary mortgage, your first mortgage that most people have that they use to acquire the home. But it's a revolving line of credit, meaning it acts like a credit card. There's a draw period, and typically it's 10 years. And during that draw period, you can use it up to its maximum amount and then pay it down and use it again and pay it down. It's not an installment loan. It becomes an installment loan after that draw period. So you have a 10-year draw period typically, and then it becomes a 10 or a 15-year installment loan where you're just making regular monthly payments in order to pay the balance off over that loan, and you can't draw on it anymore. So that's what a home equity line of credit is. And that's sometimes confused with what a home equity loan is. And the terminology is confusing, admittedly. Home equity loan is typically it's a second mortgage, but it's a fixed rate installment loan. And so it's not a revolving line. Usually it's a fixed rate, and it has a payment term that's fixed, and you start making those payments. So you make one draw on it, you take the loan, and then you start paying it off. It's like a car loan. You borrow the money and then you start paying off over 10 years or 15 years again. The home equity loans usually can go up to that long, or they can be shorter. And so that's your two general categories. Most home equity lines of credit have what they call a fixed rate partition, or the capacity to convert any portion of that to an installment loan. So you can take, let's say you have a $300,000 line of credit that's sitting on your home, you haven't used it, or maybe you've used $100,000 and you want to convert 50 of that to just an installment loan. You want to commit to paying that off over and fix the rate and pay it off over a particular period of time. You can partition that off and you'll still have the rest of your HELOC available. But that's the general distinction. So what are some of the reasons that you would use a home equity line of credit? One is a piggyback loan. Piggyback loans are essentially when, instead of financing a home with a single mortgage, you break it into two mortgages. Now, before the crash back in 2007, 2008, the value of these things were much greater because the cost of mortgage insurance was much higher than it is today. The cost of borrowing over 80% of the value of a home was more than it is today. The cost of a jumbo mortgage was more than it is today. And those are all good reasons to break a loan. Like, let's say you only had 10% down, you'll get an 80% first, a 10% second, and that second would be a HELOC. And so that's one reason. And those are making somewhat of a comeback. You can get those again, and there may be limited circumstances in which they're valuable to do, but that's one thing. Another thing that's very common is a home renovation loan. Now, leading up until this past year, when interest rates are going down and down and down, and you have a mortgage on your property, let's say your property is worth $600,000, $700,000, and you want to do a $100,000 remodel, and you have a $400,000 mortgage, but your interest rates that are prevailing at that time for first mortgages are lower than the mortgage you got on your property right now. So why not go ahead and just refinance the whole thing, take that $100,000 out, use that money to do your renovation. But that's not the case anymore, right? Rates have gone up. So many people are sitting on interest rates that are in the high 2s or the mid 3s or even the low 4s, and they're looking now at the 5s or a little bit higher than 5, and they're thinking twice about refinancing that whole package just so you can get $100,000 to do your renovation. And so instead they will do a home equity line of credit, and that's a very reasonable thing to do. But there's some things to consider there, and we'll talk about that. Credit card or other debt consolidations, that's also a very popular use of a home equity line of credit. If you've got credit card debt and it's accumulated to the point where you don't believe that you have a reasonable means of paying that down or getting on top of that, maybe you do a home equity line of credit, you consolidate that, you pay those all off, and there's reasons to do that. Other things, some people use them for student loans. Of course, they're not forgiven, so there's that. Investment or second home purchases, you tap into the equity of an existing home to make an investment home purchase. Car loans, bridge loans. This is a use that I think is very effective for tapping into the equity of an existing home. If you're going to leave an existing home, but you want to buy the new home first, you can tap into the equity to use to the down payment of the new home by getting a home equity line of credit. And I've done this many times. Just having liquidity. Now, I like to have a home equity line of credit. I have a small business. I'm a mortgage company owner, and I just like having some liquidity. I don't like to have to use it. And generally I don't, but I like just having just the fact that I have a home equity line of credit there. If I ever need to tap the liquidity, it's there. And it costs me very little to maintain that and keep that going. I know people who use home equity lines of credit for flips. They're in the market. Again, the market's a little different now than it was for the last several years, but where people would go out and they would use they would get a large home equity line of credit against their home. They had a lot of value, a lot of equity. And then they'd write a check for a house at auction. They could be a cash buyer. And then they could even use some of that home equity line of credit that was left over to do the improvements and then turn around and flip that and repay the line of credit. The line of credit's still there. It's there for the next one that they want to do. All good reasons to use that. This is prime rate from 1955 to 2022. Now remember, home equity lines of credit are tied to prime. And this is where the risk comes in. You can see prime can go up very sharply and very significantly. So you see, back in 55, prime is rocking around under 6%, somewhere in the fives there. And all of a sudden we get into the 80s and boy, we're in the 20% prime. So if if you were sitting on a home equity line of credit and you had significant money out on that line of credit and it was out at prime plus 0, you're at 5%, making interest-only payments, everything's going fine. Well, now, next thing you know, you're at 20%. So that's where the risk comes in primarily for these home equity lines of credit, and that's what you want to mitigate against. So I generally tend to tell you that, tend to think that home equity lines of credit are great for short-term needs, but you need to have a repayment strategy. Have a repayment view in mind when you go into it, so you're not indefinitely committing large amounts of money at a variable interest rate that you really have no control over and might be significantly impacted by. And that really needs to be your first consideration. Most housing debt, you're talking about investing in a house. That's a long-term asset, usually with a long-term use. And so you need a repayment strategy. You need to think about that. And if you're going to use a home equity line of credit for a renovation loan, it also tends to be a fairly substantial loan amount. It's a fairly high loan amount. And so you've got a lot of money out there for a long period of time at risk of interest rate changes because it's a variable line of credit. And so you want to keep that in mind while you're considering whether a home equity line of credit is a good vehicle for this long-term project. Are you going to pay it off for the 30 years? Your first mortgage is probably a 30-year mortgage, and so you do want to try and match this. Maybe you got 25 years left on that on that mortgage. You want to match the repayment term with that. Or are you thinking about renovation? Are you going to use a HELOC to temporarily fund this? And this would be the ideal case, where maybe you've got bonuses that happen, from time to time. You get considerable bonuses, and you think that over the course of 3 or 4 years, you'll be able to apply those bonuses to repay that home equity line of credit and fully pay for that renovation. Well, that would be okay, because then you're mitigating that risk of having a lot of money out there for a long period of time with the short repayment expectation. And so that risk isn't for a very long period of time, and you can mitigate that risk. Maybe you have an inheritance coming, or maybe you have some stock that you want to sell, but the stock market's down and the value of your stocks are down and you don't want to sell just yet, so you take out a home equity line of credit to give those stocks time to recover, and then you sell those down the road. And again, having those stocks, even if they don't recover, you're mitigating that risk because you're intending to liquidate that and pay off, or at least pay down substantially. So that's one of the things to consider when you're looking at a renovation loan. Now, what about the alternatives? When you're deciding on a home equity line of credit versus alternatives for a renovation loan, what are the alternatives? And what are the costs to obtain a home equity line of credit versus the alternatives? And what are the costs to maintain? Typically, you can get a home equity line of credit for free. This is very different market to market. Home equity lines of credit are very much niche products that aren't the standardized boxes that Fannie and Freddie have, that everybody's doing the same thing. So you definitely want to call around, and most of the time your local credit unions are going to be pretty good sources of these things. Call your local credit union, and a lot of times you can get them for free. What are your alternatives? Well, maybe you can get a 401k loan. 401k loans might be a reasonable option. One of the benefits of a 401k loan is, hey, they're cheap to get, right? You go to your employer if they offer them, assuming you have a 401k. By federal law, you can borrow, the maximum you can borrow is up to $50,000 or 50% of the value of your 401k, whichever is less. So that might be a way to go. Getting a 401k, it's an installment only. One of the downsides of that, though, is you're tethered to that employer. If you ever lose that job or quit that job, change jobs, that loan that you had against your 401k has to either be repaid or it becomes a distribution from your 401k, and you probably don't want that. So you can do a cash out refinance instead. What if you're going to do a $200,000 remodel and you only have $100,000 left on your first mortgage? Well, in that case, the weighted average, the relative weight of those two loans is much more balanced toward the home equity line of credit. That $100,000 that you have at a low interest rate isn't impacting your overall cost of money as much as that $200,000 will impact. So maybe it's worth going ahead and refinancing the whole thing into a new $300,000 loan at 5% or even 5 3/8%, because most of your money is going to be at a new mortgage rate anyway, and you want to fix that rate in or whatever the current market is. I should mention, if you do a cash out refinance, the existing value of the home has to support that. So if you, in our example, had $100,000 on your mortgage and you wanted to do a $200,000 refinance, but your house is only as is worth $350,000, well, maybe that's going to be hard to borrow. Maybe that's going to be hard to manage, because you can't take into consideration the value of those improvements when you're just doing a cash out refinance. That's what a construction loan is for. So a true classic construction loan is you get plans and specs and you get a contract, and you take that to an appraiser and you say, tell me what this will be once this is all done. And then the lender says, oh yeah, that's going to be worth $600,000, and you say, okay, I want to borrow $300,000 against that. That's what a true construction loan is for, and they're a great product for doing that, but they're extremely cumbersome. Construction loans are expensive. They have extra fees because you have to get your builder approved. You have to get your project approved, which means you need permits and plans and specs and detailed cost of materials and appraisal based upon the plans and specs and whatnot. And then they don't just give you, here's your $300,000, go build your house. They say, okay, we're going to pay off your first mortgage when we close your construction loan, once all these things have been approved, and then we're going to send somebody out there every month to inspect the property, see what's been done, see how that compares to what the list of materials was, and then we'll make monthly draws. And so there's a lot of extra cost associated with that, and there's a lot of inconvenience associated with that. So just be prepared for that. Construction loans are great when you need it, but they're more expensive. If you can do it with a cash out refinance, a lot of times that's just better than trying to do it with a construction loan. So if the existing value supports the additional money that you need, usually that's going to be a superior just to do a cash out refinance in a construction loan. Maybe the one area where a construction loan excels over the just doing a cash out refinance is the money is dispersed only as needed, and typically interest is only charged on the dispersed balance of a construction loan. So you're not going to need that full $200,000 up front. You're going to pay that contractor over time, so that balance will build over that first year when you're actually doing the project. Slight edge to a construction loan in that situation. The other thing to consider is monthly payment. On a HELOC, you have interest only. HELOCs generally have a 10-year draw, 15-year repayment, and the payment is lower during that interest-only term. And so maybe you need that, especially during the construction term. Maybe you need to move out of your house. Maybe you need to rent. A home equity line of credit might serve that purpose well. Now, a home equity loan, typically, again, it's a 15-year max. And so if instead you don't want to have the risk associated with a home equity line of credit, you just get a home equity loan, and it's a fixed rate and it's 15 years, and you're just making that payment as you go. But you also have to continue to make your first mortgage payment. Just be prepared to make both of those payments for the duration. HELOCs are simple, easy to do, take about 4 or 5 weeks to get. Go to your local bank, credit union, whereas a construction loan is pretty cumbersome to get. Here's one that you might not think about with a construction loan is the cost of your project and the flexibility in doing the project. A lot of people want to do some element of their remodel project, even if it's as little as, hey, I want to paint. I can paint, I can pick up a paintbrush, I can paint some of the things. I want to save money by not paying a professional painter to do what I can do. And then some people are a lot more skilled than that, and they have all the skills. They can do electrical, they can do plumbing, sheetrock. They want to do it all. And just need to be aware that virtually all construction loans are extremely limiting on DIY, if not just absolutely prohibiting any sort of do-it-yourself on because a lender, when they're lending, they don't want to lend a whole lot of money to you on the basis, and this will also impact your estimate, your cost estimate. You can't give them a cost estimate that says this is only going to cost me $100,000 because I'm going to do all the work myself. They will want to factor in, well, what if you don't finish? What if you die? What if you lose interest? What if you're not capable? Then we have to go hire somebody. We're stuck with a property that's partly done. We've got a security interest in this property. We can't sell it as is. We've got to hire somebody to go in there and finish it, and they're going to charge market rates. And so most construction loans are going to be extremely limiting. So if you are a DIYer and you have the ability and capacity to do the work on your own, then you're pretty much going to want to go with a home equity line of credit for that money. And then impacts on the other costs, on cost of other money. Let's say, like we talked about earlier, that you have stocks that you want to liquidate, but due to stock market fluctuations, the value is down. You don't want to do that now. The other thing that might come into play is income tax timing. Maybe you have already have a significant income this year, and next year is going to be less, and you don't want to liquidate all that stock all at one time and pop you up into a higher tax bracket. So maybe you get a home equity line of credit so that you can fund part of the construction with this home equity line of credit, and then liquidate some stock in 1 year and some stock in another year. So those are some things. Sorry, this has been pretty much a shotgun approach, but hopefully you found that helpful. Thanks again.